One of these assets could protect your future, one could multiply it, and one could quietly build wealth while you're too distracted to notice. Most Americans argue about gold, Bitcoin, and stocks like they're picking teams, but this was never about teams. It was always about survival. Hey everyone, I'm Jack. Today we're going to talk about something deeper than investing. We're going to talk about trust. Trust in governments, trust in markets, trust in technology, and maybe the hardest trust of all, trust in your own patience. Because the final winner between gold, Bitcoin, and stocks is not decided on a chart, it's decided in real life, during layoffs, recessions, inflation, panic headlines, and those quiet nights when you open your bank app and wonder if you're falling behind. Picture a normal American worker. Maybe he earns around $60,000 a year. Maybe she earns a little less, maybe a little more. It doesn't matter much anymore, because the pressure often feels the same. Rent climbs, groceries rise, insurance renewals feel like punishment. Car repairs never arrive when convenient. Taxes leave before you even touch the money. Somewhere in that pressure comes the sentence, "Millions here every week. You need to invest." So they look around and see three loud doors. Gold, the old king. Bitcoin, the rebellious newcomer. Stocks, the polished machine tied to retirement accounts and corporate America. Each door promises something different. Safety, freedom, growth. But promises are cheap. Reality sends invoices. Let's start with gold, because gold doesn't care whether people think it's boring. Gold has watched empires rise, currencies collapse, wars begin, politicians promise miracles, and families hide coins in drawers when trust disappeared. That matters. In a world addicted to speed, gold represents memory. For thousands of years, human beings across continents agreed that this yellow metal carried value. No marketing department did that. No influencer campaign did that. Time did that. If your grandparents distrusted banks, there's a reason many of them trusted gold more than a password. But Americans often misunderstand what gold does. Gold is not usually the flashy winner in prosperous decades. It doesn't wake up excited to beat tech stocks on a random Tuesday. Gold tends to shine when confidence cracks. During inflation scares, currency fears, geopolitical stress, banking anxiety, gold often gets attention because people stop asking how to get rich fast and start asking how to not get poor slowly. Those are different questions, and most people only learn the difference after pain. There's also something psychological about holding gold. It doesn't send notifications. It doesn't tempt you with meme headlines. It doesn't scream that you're missing the next moonshot. It just sits there with the patience of a mountain. Sometimes boring is a feature, not a flaw. In a culture where people refresh prices every 6 minutes, boredom can be protection. But gold has weaknesses, and pretending otherwise is how people get trapped. Gold does not produce earnings. It does not invent software. It does not pay dividends because it had a productive quarter. If you buy gold and wait, your success depends largely on future buyers valuing it more or valuing stability more. Over very long periods, productive businesses have often outperformed gold because businesses create goods, services, profits, and expansion. Gold stores value better than it compounds value. Those are not the same job. And then there's storage. If you physically own gold, you need security. If you store it elsewhere, you need trust. If you buy paper gold products, then some people argue you're back in the system you were trying to hedge against. Funny how modern life works. Even escaping complexity often requires more complexity. Now, let's talk about Bitcoin, the asset that can make a quiet family dinner become a 3-hour debate. Bitcoin entered a world already frustrated. After the 2008 financial crisis, millions watched banks get rescued while ordinary people dealt with foreclosures, job loss, and years of recovery. Trust had cracks in it. Into that environment came an idea: a scarce digital asset outside traditional control, capped in supply, portable across borders, transferable online. For many, Bitcoin was not just an investment, it was a protest, and what a protest it became. Few assets in modern history have produced the kind of returns Bitcoin delivered in its early years. Tiny amounts turned into life-changing sums for some believers. That story matters because stories move money faster than spreadsheets. Every time someone hears that a modest purchase years ago became millions, rational thinking must fight emotional imagination. Usually, imagination wins first. But Bitcoin also introduced a new kind of stress to average Americans. Traditional market drops feel painful enough. Bitcoin has seen drawdowns so violent that many people discovered their risk tolerance was fictional. Saying you can handle volatility in a coffee shop is easy. Watching your holdings fall 50% while bills remain 100% due is different. That's when philosophy meets rent. Be honest with yourself for a second. If something you owned dropped 60% in 6 months, would you calmly buy more, or would you suddenly become long-term skeptical? Let me know in the comments, because this is where theory becomes personality. Bitcoin supporters praise scarcity, decentralization, portability, and the possibility that it becomes digital gold or even something larger. Critics point to regulation risk, competition from future technologies, security mistakes, scams around the ecosystem, and the fact that an asset can be scarce yet still wildly overpriced in a mania. Scarcity alone doesn't guarantee wisdom. There are scarce bad ideas too. There's another hidden cost with Bitcoin: attention. Some people don't own Bitcoin. Bitcoin owns them. They wake up checking prices. They sleep checking charts. They become unpaid macroeconomists overnight. Federal Reserve meeting? Check chart. CPI report? Check chart. Random tweet from a billionaire? Check chart. If an investment steals your peace, the return calculation may be incomplete. Now, stocks. The least dramatic answer is often the one people ignore. Stocks represent ownership in businesses. Real companies selling products, collecting revenue, paying employees, adapting, failing, succeeding, merging, innovating. When Americans buy broad stock indexes, they're often buying a slice of productive capacity itself. That's why stocks historically became one of the strongest long-term wealth builders available to ordinary people, especially through diversified index funds. This doesn't mean stocks are painless. Ask anyone who watched retirement accounts during 2008. Ask anyone who saw markets plunge during early 2020 before a stunning rebound. Ask workers who kept contributing while headlines screamed catastrophe. Stocks reward patience, but they test patience first. That's the tuition. The beauty of stocks is compounding. A company earns money, reinvests, grows, sometimes pays dividends, expands market share, improves efficiency, and over time, the machine can become larger than most people emotionally appreciate. This is why many fortunes were built not through genius timing, but through staying invested longer than others could tolerate. But stocks also carry a psychological trap. Because they're accessible through apps, many Americans treat ownership of businesses like sports betting with prettier language. They chase hot tickers, confuse lucky gains with skill, panic sell during corrections, then buy back higher after confidence returns. The market has a habit of transferring money from impatience to patience while making impatience feel smart in the moment. Think about a worker contributing monthly to a retirement plan for 20 years. Not glamorous, No viral screenshots, no dramatic dinner stories, just payroll deductions, reinvested dividends, market crashes survived, bull markets partially enjoyed, and a growing balance built by repetition. That person rarely trends online, but many times that person quietly wins. So who wins? Gold, Bitcoin, or stocks? Wrong question. The better question is, wins for what? If the world feels unstable and you fear currency erosion, gold may feel like sanity. If you believe digital scarcity reshapes finance and can emotionally survive chaos, Bitcoin may feel like conviction. If you want ownership in productive systems and long-term compounding, stocks may feel like logic. Same world, different priorities. This is where many Americans get hurt. They ask one asset to do every job. They want gold to grow like tech stocks. They want Bitcoin to feel stable like cash. They want stocks to never crash. They want reward without discomfort, growth without volatility, safety without trade-offs. Markets rarely offer that combination for free. Let's make it more real. Imagine someone bought gold before a fearful decade. They may feel smart when inflation headlines rise. Imagine someone bought Bitcoin during despair and held through recovery. They may feel brilliant. Imagine someone bought diversified stocks consistently for decades. They may feel almost nothing day to day, until one day they realize time did heavy lifting while they were busy living. Which feeling do you want? Excitement? Protection? Quiet progress? There's no universal answer, but there are consequences to each choice. Another truth people avoid: behavior often matters more than asset selection. A disciplined stock investor can outperform a chaotic Bitcoin trader. A patient gold holder can outperform someone who panic rotates between everything every 6 months. A mediocre strategy followed consistently can beat a brilliant strategy abandoned emotionally. And then taxes enter the room like an uninvited relative. Frequent trading can create tax drag. Poor timing can create losses with no emotional refund. Selling winners too early, buying back badly, chasing headlines, paying fees, spreading across random platforms. These things silently reduce results. Many investors lose not to markets, but to friction. Social media made this worse. You see someone bragging about crypto gains. Someone else shows dividend income screenshots. Another posts a vault of gold bars they probably rented for content. Suddenly, your steady plan feels boring. Comparison is expensive. It convinces people to abandon workable paths for louder ones. Have you ever sold an asset, watched it rise later, and then pretended you meant to reduce risk? Be honest. Comment yes or no. Most investors have a story like that, and it teaches humility fast. Now for the uncomfortable truth. The final winner is often the asset you can hold through embarrassment. When your friends mock gold as outdated, when they mock stocks as slow, when they mock Bitcoin as fake or dangerous or dead for the 17th time. Can you hold your plan when applause disappears? Because applause usually peaks near tops. For many Americans, a blended reality may make more sense than a tribal answer. Some use stocks for growth, gold for stability, Bitcoin for asymmetric upside. Not because one must defeat the others, but because life itself contains multiple risks: job risk, inflation risk, policy risk, longevity risk, emotional risk. Different tools exist for different storms. Still, if history forced one broad answer for the average person with decades ahead, productive diversified stocks have often been the strongest long-run wealth engine because businesses adapt, earn, and compound. That doesn't make them easiest. It makes them historically powerful. Gold often protected. Bitcoin sometimes exploded. Stocks often compounded. But if you cannot stay invested during crashes, even the best performing asset on paper may be useless to you. The spreadsheet winner and the human winner are not always the same person. So, maybe the final winner isn't gold, Bitcoin, or stocks. Maybe it's discipline. Maybe it's patience. Maybe it's the ability to ignore noise long enough for reality to reward consistency. Because in the end, the asset that changes your life is usually the one you understood well enough to keep holding when everyone else lost their mind.